So today I'm going to talk with the amazing Dashaun Dunn. Good morning, good afternoon, whatever time of day it is when you're watching this. Today I have the honor of talking to the amazing Dashaun Dunn. And as you know, in Vanda Crossley fashion, I want to know who people are, what their background is, why they're doing what they're doing, what their passion is. And just a little introduction. I met Dashaun through my daughter Erica. We have monthly networking events, and he comes to several of those. We have backyard pool parties. He's come there, so he's a friend of the family. So I want to welcome you, Dashaun, and I'm so glad we got the time to get to know you. So tell us a little bit about you.
Yeah, well, thanks for having me on, Vanda. You're right. We did meet through Erica, who I consider a sister. And since coming to Texas, I came out to Texas in August 2017. And you guys have been like always when I'm kind of explaining that our connection, I always say like you guys are my adopted family here. Like you're inviting me to the cookouts. I'm coming over to hang out. You're a realtor, so I'm showing up at networking events and networking. So you and the rest of the family, Erica, have been like my adopted family here. So
Real good. We feel the same way.
yeah. What was the question again? I forgot. I kind of got into our connection, but
So tell me a little bit about your background.
okay. Well, again, I'm really from California, straight out of Compton. And actually what brought me here to Texas was a psychology internship. And so my background is actually in mental health. I was a therapist for many years and I always liked helping people. So that's at the core of what I'm interested in. And what drives me is helping people. I actually transitioned away from mental health. Was that 2024? Yeah. And decided I needed something different. And, I had that entrepreneur mindset. And here I am actually now servicing people with life insurance. And before I landed here, I actually had my own policy started in 2023. And, when I started to explore different avenues of what I can be doing in my next chapter, I thought back and, how amazed I was about what this particular type of policy can do for people. And I was like, more people need to know about this. Is this something I can do? And I called up the agent that got my policy started, and here I am today, now a licensed insurance agent, helping people with several things. But my main bread and butter that I think is the most important thing to learn about in life insurance is like the catchy name is called debt-free life policies, helping people understand how they can keep their money working for them and create a legacy by doing the things that they're already doing. And we'll get more into that. But yeah, that's how I landed here. It was something I felt like more people need to learn about. I'm passionate about it. And that's really, for me, it's important. If I can be passionate about it and I feel like people can get value from it, then I'm interested.
So they didn't call you asking you to become an agent. You actually reached out to your agent and said, "Hey, I like this so much. I want to do what you're doing, helping people."
Yeah, exactly. And I gave him a call, asked him what the process was. Had to get take an exam, study for about a couple weeks, and yeah, it's just something I felt like, you know, especially for me coming from the mental health background and feeling really, passionate about mental health and understanding that people need to focus on mental health. And I consider it, if mental health is here as far as importance, I do believe life insurance and the type of policies I'm interested in is right on par with that because it impacts our finances and the way we live our lives in many ways. And so if you can focus on your mental health and have your finances and life insurance in check so that your family's going to benefit when you die, I think I'm not going to say one is more important than the other, but it's a big piece of the puzzle, the pie when you're talking about living this life here.
I don't know if you know this or not. We haven't talked about it, but I used to sell life insurance back in the
Mhm.
80s. I was with, it was called A.L. Williams at the time, and then it transitioned over to Primerica, which is what it is now.
Okay, yeah.
I had my life insurance, and then my husband had his Series 7, I believe it is, so that he could do the mutual fund part because
Mm,
their thing was buy term and invest the difference. So
right.
in my mind, that's all I ever, you know, thought about was if you have enough life insurance, you're okay if you're low on cash. And if you got the cash, you don't need a lot of life insurance. So that's kind of the way I don't know if you call it brainwash, but that's the way they were teaching us back then. And so I don't
Yeah.
know if it's different now. My kids are all grown now, so I don't, have that term life insurance is gone. The term is over now. So
Yeah, and that's the again my short term learning this that's something that if a client wants term, obviously going to service them in the way that they feel they need it. But what I learned about term is like what less than 2 or even 1% of term policies are actually paid out, and so like the reason why I focus on the whole life policy is like not only are you going to be putting your money where it's going to be working for you, um, you're essentially when they're designed right, if you live long enough, it's almost free in a sense. Like your money is essentially you get it all back or your family's going to get it all back, and so it's a really amazing policy. Like my grandparents had life insurance policies, but they didn't know about this particular time. And you're saying you're a life insurance agent in the 80s. I was actually on a webinar a couple of weeks ago. Guy's been in the industry for over 20 years. He was like, I never heard of this type of policy or being used this way. And so it's not something that's well known, unfortunately, but it's been around 200 plus years, and it's just a matter of education. And for me, I've always been big on education, whether it's mental health, personal development, finances. And so that's something that's just fit along with me. So that's why I'm here.
okay, well, I'm anxious to hear about what you have, and I agree, and I know that depending on who you're working for, that's the product that they push and sell.
Hmm.
So I'm also a loan officer. I'm with a broker, so we have over 200 companies. But if you ask one company if they do blah blah blah, they're like no. You ask another one, they do blah blah blah, they're like yes. So it just depends on what company you're talking with. So
Yeah.
Ed, do you want to share your screen and tell us a little
Yeah.
about it?
Let's go ahead and do it.
Okay.
See here. Share my screen.
Yep, I see it coming.
Okay. And as far as what you can see on the screen is what exactly? Just the first slide?
Yep, Debt Free Life, Dashaun Dunn, and then the NPN number. What's NPN stand
All
for?
right, yes, my national producer number. And so, agents, life insurance agents, we're held accountable by the life insurance industry that basically holds us accountable for making sure we're doing right by our clients. We're not just telling them to get this policy or that policy that's going to benefit me as an agent, right? And so I'm able to be held accountable by the information that I'm sharing. And again, essentially, in a more concise ways, it's regulated. And so, but yeah, so I've been an agent for a little over 3, 4 months now. And the one thing, the one reason why I became a life insurance agent was because of the exact policy that I have, and it's called a uh, dividend paying participating whole life insurance policy, and I'll get more into that later. But essentially, like for easier terms of use, we like to call it the debt free life program here. And also it's you may have heard infinite banking concepts, and so that's what we're going to be talking about today. Again, other people may have other needs for certain things, but this could be encompassing of all of one's needs. And so to explain what it is. I think one of the best ways to explain it is kind of tell about a testimonial. And here's one of our clients that we've had. She said, I'm going to kind of read it from verbatim just so you kind of get a sense of what she was talking about. Her name is Jamie, and she's a nurse. And she said, I had nearly 12 years of scheduled debt payments piled up in front of me, nurses' school loans, mortgage, cars, credit cards. With my infinite bank, I'll be completely debt free in 4.5 years without adding a penny to my monthly bills. In 20 years, I'll have over 900,000 in assets. In 30 years will be over 1.7 million. That money is an additional retirement income and it's all tax free. While the money's great, knowing that I'll be able to cut back on my hours and have more time to spend with my family is what really matters most to me. And so, again, we're going to get into how this works, but imagine, and that's why we're here talking about now. You're a realtor. You help people sell their homes, buy homes. Sometimes I know realtors have what they call, I believe it's called a turn down list because their debt to income ratio is just a little bit too high, and they're going to be in debt for years. But when I saw this, what this policy can do, taking the traditional 30-year mortgage down to 9 years or less, including other card debt, credit card debt, in under 9 years or less, I had to figure out like, how does this work and how can I share it with other people? And so we have multiple testimonies, and you'll probably hear a few more. But this is what I want to share with people. There's mostly we're either the debtor where we're saying, hey, bank, can I get a loan? Or credit card companies, I would like a credit card so I can kind of use credit to get by or pay for X, Y, and Z. Or you're a saver. You're going to save your money in Chase, Wells Fargo's bank, and that money's working for you in a lazy way, I'll say. It's earning you some percentage, but you're not the one who's really profiting from that. The banks is making a lot of money, and I'll show you a little bit later about how that works. But here, as the debtor, you go in debt and you work your way back up to pay down that debt, and then you do it again. So let's say this is a credit card or this is your car note, and you just keep doing it again. You're gonna have several cars over the course of your life, right? And so this is most people, and their money is consistently tied up into this. And when you're the savior, hey, I'm going to stack up a little bit money. I'm going to save 5,000, 10,000, 30,000, put a down payment on a house. And then when you buy that car, you pay that money on the house, the money is gone for you for forever. You can never get that money back to start working for you. What we do, we help people keep their money working for them consistently. So your money, every dollar that you earn, imagine being able to not only that money is going to service you for the rest of your life and go to work for you, but what if you were able to give it to your kids and your kids' kids? Like that money stayed in your family, making money in perpetuity. That's the power of these whole life infinite banking policies. And let me go back here for a second. And so again, like in the other examples, we were saying, okay, you go down in debt or you say that money's gone, right? It's now going to work for someone else. But here, when you borrow from your policy, you're that money continues to grow. And I have some slides that'll kind of be better able to explain it, but it never stops working for you, no matter how much you borrow from it, or for example. So, and we'll get into that, but that's the basis of what we're talking about here. And so again, infinite banking. Again, just imagine if every dollar you made was suddenly worth $2. If all your debts were paid off, would your life be more comfortable? A lot of people are dealing with debt. A lot of people are just doing it what they were taught. You kind of talk about like we were programmed today, right? In insurance companies, it's the way I like to look at it is it's essentially different schools of thought. People can continue doing what they're already doing, but where is that getting you? Would you rather learn a way that every dollar that you're earning can be used in multiple places, two places, and is going to continue working for you even after you spend it on a trip in Hawaii? It's that type of concept, and it can be confusing at first, but it's really simple. So, who uses infinite banking? Magic Johnson, he has a banking policy. A lot of Congress people, Warren Buffett. You may have heard of Walt Disney, Ray Kroc, the founder. I saw the movie, so I want to call him the founder, but he bought McDonald's and turned it into something more. There's been numerous examples of people using this policy. Going back to Walt Disney, he was in a bind. He was in a bind and he used his policy to borrow from to fund the building of Walt Disney. And imagine if we became our own bank and we were able to fund our life and everyday expenses while our money continued to work for us. Actually, Nelson Nash is the one who has been, he's the one who's been teaching everyone back in the 80s. I'll talk a little bit about him later, but Nelson Nash, the book Becoming Your Own Banker, highly recommend it. You got to read it. It'll teach you more about this process and how you can get it started. So, uh, what's important to understand about this concept, infinite banking? Think about it this way: it's it's a your premium payment, like other life insurance policies, is important. But essentially, you want to think about it like it's going into a cup here, and essentially it's going to lead to two things. You're going to have a tax-free death benefit. So nobody makes it out of here alive. You're going to die. Your family benefits and are able to take care of the things necessary related to your funeral expenses, sometimes mortgages left over, or even other debts. And the other thing that I was talking about here, tax-free compound interest account. That money that you're putting in is compounding, um, tax free, uninterrupted while you're living, and you get to use the funds while you're living. And so that is where it's essentially saying, okay, do you want your money working for someone else in someone else's bank, or would you want your money working for you in your bank? That's what we're talking about here. So I like to think of this as a savings account on steroids. Savings account are great, CDs are great, but with this, you're going to be able to earn more interest on your money compared to keeping it in a traditional savings account or even a CD account, a high yield savings account. You're going to get guaranteed growth every year out of the policy. And, with the insurance companies that we deal with, they declare dividends just about every year. I wouldn't say the dividend is guaranteed, but I will say this. It was, I think, one company didn't declare a dividend during the depression year, that one year. So it's not guaranteed, but it's almost guaranteed that, you know, unless the world is crashing, it's they're going to be doing pretty good. You get to use every dollar twice. You have your ability to put your money in the bucket here, borrow from the policy and go use it to buy a car, to use it to pay down debt, to use it to buy a house while your money is still growing. So you get to use it in multiple places. That's what we mean by that. You get access to cash without penalty, unlike your 401k, your IRA, things like that. You have it accessible to you. You get to generate additional income because your money is growing over time. You get dividends every year. You have greater control over your money. Imagine being able to say, "Hey, I need a $5,000 loan." Instead of having to apply for a credit card or get a loan from the bank, go to the applications, being able to make a phone call or push a button. Go ahead, man. I see. Oh, well, did I put my hand up, or I guess I did
Yeah, you
that.
did. When you raised we got AI now, so when you raised your hand, it said, "Oh, you put your hand up."
Oh, okay, okay. I don't even know how to. Okay, Lower hand. Okay, got it. All right. All right.
Right.
So, but yeah, you get greater control of your money. No, you are essentially creating a what I like to say is like you're creating a business entity with the insurance company, and you have say where that money is going. So you don't need to ask or beg. You just need to say, hey, this is what I want to do. I want this amount of money, and it's going to be in your account in 3 to 5 days.
I do have a question though. Can
Yeah.
multiple people be on a policy?
It's going to be one owner on the policy. So one owner and then a beneficiary, and you can have like uh, uh, a another person who's say if you die, the other person can be the person that owns it, but it's only one person that will be the owner.
It can't be a entity like LLC.
Well, yeah. So yes, LLCs and trusts can be the owner of the policy, and you can have a policy on yourself. And that's a great point that you bring up. Business owners would love how these policies can give them access to cash flow. Um, Imagine instead of keeping your taxes in a savings account, waiting to pay it at the end of the year, what if that money was working in your infinite banking policy? You take it out when it's time, give it to the tax man, right? And it's still growing for you instead of just giving away when it's no longer working for you.
Okay.
Yeah. And it's part of the reason why they named it infinite banking. There's so many things you can do with this policy.
Okay.
Yeah. So again, shelter your assets. Assets. Again, it provides tax-free income. It puts your money in a place where, unlike the stock market, which is going up and down and taking losses, and you gaining 100% back of the loss, but you still, when you really do the math, you understand that you still took a loss and you haven't gained back everything. It's a way to protect it, and you're creating generational wealth. Every dollar that you're earning will be able to be passed down to your beneficiary. And if you teach them the same process, they put that money into a policy and it just goes to the next person, the next generation, the next generation.
So I got another question. So
Yeah.
can the beneficiary of the policy be a nonprofit?
Actually, yes, I believe so. Yes, I actually was watching a webinar on that last week where donors are able to not only donate and give to other charities, nonprofits, the beneficiary can actually be a nonprofit organization. It could be
Okay.
a church, pastors. You know, when you pass, when a pastor passes, why not have a policy set up for to the money flows straight directly to the church? Again,
Right.
infinite amount of ways that this can be used.
Okay. Just some things to think about, you know?
Yeah, yeah. So let's get into what is it? Again, it's a participating whole life insurance policy. It's not your typical life insurance policy that, again, whether it's term or whole life, that just builds cash. It does a little bit more than that. And so the whole phrase would be a participating, dividend paying whole life insurance policy. And so it essentially uses like tax code to create a protected and guaranteed financial vehicle inside of a life insurance policy. And it needs to be structured correctly so that the IRS won't say, hey, this is an investment. We need a piece of our cut. So when you structure it the right way, it will not be an taxable event like your 401k, your IRA, and so on. And so it does have a death benefit, but again, it's structured to minimize the death benefit and maximize cash accumulation with the program and how we do it here. So I did talk about like higher interest rate, right? And so in your typical bank, what are you getting? Your money's like what I mentioned is lazy. It's working for you. Keep if you want your money to stay working for you in a lazy manner, keep it in your Wells Fargo, your Chase Bank. while it continues to make money for Wells Fargo and Chase Bank. Typical banks, you're going to get with maybe point something 0%. Up here, we have 42%. Whereas in your Infinite Bank, it's earning you 5.8 over the past 3 years. And if you take a look at over the past 20 some odd years, let's take a look at what it's been doing. Let's go back to 2004, 6.0%. Again, it's zero risk, zero risk. You can't lose money in this policy. Most people remember 2008, the housing market crash. Still, your money earned 6.3% that year. What about 2020? Pandemic, 5.8. So your money is going to grow at a guaranteed rate versus making someone else wealthy, leaving your money in someone else's bank. Why not put it in your bank so that your family can benefit from that?
Something happened with my screen. I don't know why I don't know what you're seeing on your end, but mine, it just went small for some reason.
Hmm. See.
Um, I was seeing your screen, but it went small, like it just went away. Now I
Mhm.
just see me. Oh, let's
Something
see.
something happened on my end too. My presentation. Uh,
Oh, wait, there we go. But I still see me, you. I don't see your presentation.
okay, let me see here. Let me share my screen again.
Okay, there we go.
Okay, gotta share the right screen. Let's see. How about now?
Let's make it bigger. And we're back in business.
Okay.
All right.
All right. So I remember when I said it's like almost free. Over time, your contributions is going to decrease, unlike other policies. Sometimes I think about how veterans they believe they're taken care of with their policies from the that's I guess regulated by the government, but as you age, every 5 years the policy increases, the premium increases. And I think about my grandfather who was in the Navy. He didn't have a large policy. We had enough to I guess they get the barrier for free, but there was no real insurance policy to help us during that time. And I imagine he had a very similar policy that a lot of veterans do. Every 5 years it increases, and it gets to the point when you're in older age and your income typically decreases and you're no longer able to afford the policy because it just every 5 years it increases. But this policy is going to decrease over time, and the cash accumulation can actually begin to pay for your policy at a certain point where you won't have to pay into it. Again, there's so many things that you can do. And then we talk about the cash value and the death benefit. It just keeps growing. You're never going to be able to put in more money into the policy that's going to exceed the death benefit. So if you're putting in 60,000 over the lifetime or 100,000, that death benefit is going to kick back into your family far more than what you could do. And actually it gets to the point where you can get a yearly income from it. Imagine being able to set up a policy in a way where at 65, 70, it's paying you 60,000 a year tax free. 80K a year tax free, 120K a year tax free
Wow.
until you die. And then whatever's kind of left over, your family gets the rest of that death benefit. So very powerful policies that you can have here. So here's something that I really want people to consider here. So again, your typical bank, right? You have $10,000 in the bank and life is happening. You need $9,000. What happens when you have to use that 9,000 for something else? How much is left in the bank? $1,000. How much is working for you in the bank now. $1,000 at 0.42%, right? That's some better. Something is better than nothing. But here's what you can do with an infinite bank. You have the same $10,000 in your account, and you need to borrow nine. But how much is this working for you, building wealth, compounding, uninterrupted? The whole 10,000 is still working for you while you had to use the 9,000 for some sort of life event. You just wanted to go to Hawaii. You wanted to do whatever. You're using your money in two places. So
How's that possible?
yeah, great question. Let's break that down a little bit. So think about the 10,000 here that you have. It's the cash accumulation fund that you're every month, every year you're putting into that fund. Well, the insurance company says, "Hey, well, we're in business together. I trust you with your money. You're a good person. You get to borrow from their cash value while this cash value continues to grow." And earlier I mentioned you have a lot of flexibility. So when the insurance company says, "Oh, you get to borrow," let me make this clear, up to 90% of the cash value, right? Up to 90%. And the life insurance said, "Okay, we're going to use your death benefit as collateral for this loan."
Mhm.
So you have this pile of cash here still growing for you while the insurance company allows you to borrow from their funds, and they have in mind that, hey, we have a life insurance policy for this person. There's a death benefit. We're going to strategically loan them whatever up to 90%. And here's the great thing. You have the flexibility to say, hey, you know what? I'm going to decide to pay myself back in 5 years. I'll start paying myself back in 5 years, or the policy loan back in 5 years, or you can start it back the next month. There's so much flexibility. Unlike the bank, if you take a loan out there, hey, I don't care what happens in your family, your life is life, and we need that payment, or we're coming for your house. We're
Everybody.
Yeah, we're coming for the car. We're going to repo it, and they got videos on Facebook was getting millions of views of people just getting their car. Like, that's his whole business, repo, and it's sad to see, and it's they make it comical, but it's sad. People are having a hard time because we're used to giving our money to the phone bills, the light bills, and it's just going away from us, never working for us again. You're not changing much. You're just essentially, the way I like to put it is, you're taking it out of one pocket and transfer it to the next. Meaning, like, you're taking it out of this pocket that's in your typical bank, and you're putting in this pocket, which is going to earn you in uninterrupted compound interest, and you get to use your money to pay your light bill, your phone bill, your car note. You're just adding one step into the process.
Hmm.
So, generating additional income. So again, uh, this part where it comes down to your typical bank, get a personal loan, it's around like 11.05%, right? When you borrow money, it's not, the insurance company is a business still. They need to make money. So when you borrow from yourself, you need to make money. They need to make money. And so here's what happens. You're going to borrow from yourself at 5.8%, but you're going to earn, let's say, 5.8% on the interest. The company's going to earn 5.8. And so when it comes down to it, there's ways for you to actually earn and make money when you're borrowing from yourself. I have a more detailed slide that's not here, but think about it. When you take a loan from a typical bank, not only are you using the money to get that loan to do whatever needs happen, but the bank is making money, not you. But here, because you're a part of the bank, you're a part owner of the bank, you get to make money off of the 5%. Let's say the loan that you have to pay back is 5%, but you're making more than that. And again, it can get a little bit more detailed, but I wanted to keep it very brief here. But you making money while you're borrowing money from yourself, essentially. Greater control of your money. Again, like if you lost your job and you needed 6 months to get back on your feet financially, what would happen in a traditional loan from a bank? Hey, I feel for you. but run me my money. That's just the banking industry. That's how it works. Sometimes there's some workarounds, but they're going to want their payments. The great thing that you have with this flexibility, when you borrow from yourself, you can say, "Hey, I set up a structured payment to pay myself back $25 a month, $200 a month, $500 a month, but I need to take a break on that." And you say to yourself, "Self, you're a good person. You deserve a break." Okay. Well, sure. Take a break. How long do you need? Not sure yet. Okay. Well, just let us know when you want to pick up the payments again.
Hmm.
It's wise to pay back the payment because, and I want to take a pause here to really explain. You want your money residing somewhere in a warehouse that's working for you. So let's not just borrow from ourselves and just put our money that we have to pay back in someone else's bank. The moment cash becomes available to refund yourself, right? Because you're gonna want to borrow from yourself again in the future. You're gonna want to buy a car in the future. Why not put that money back into it, your policy, so that the next time you need something, it's available? So that's the philosophy. But I just want to say, if you didn't pay yourself back, you had that flexibility, and no one's about to come report the car that you used with the money. No one, like, you can pay off your house sooner. It's so much you can do.
So is there a buy-in to that? Let's say I wanted to start a policy. Do I have to a certain amount I can start it off with, or do I have to start with making, $200 monthly payments to build up to the $10,000 savings?
Yeah, so here's the way it works. Every person is different and unique. Their finances in different places. You can start anywhere as long as you have. What we do is, and I'll show you later, but we try to help you find the money to fund the policy as much as possible. But there are lower thresholds that we can start with that can help you get started
Okay.
versus just keep your money in a traditional bank. And so some people start in $100 $200 a month. Some people are saying, hey, I want all my money in this policy. They're literally putting in 20K a year, 50K a year, 100K a year. And again, it's structured in the right way, so it's not going to become a taxable event. And that's where we coach you on. So, but yeah, it just depends on the person.
Okay.
So next year, like, so what if you pass away and you still owe 10,000, right? The traditional banks, hey, I know you're going through a loss, but yeah, we still need that money. With this type of policy, I mentioned the death benefit is going to be larger than what you owe on that loan. And before they kick out the death benefit, they're going to subtract what you owe, then give your family, the beneficiary, the rest of the loan. So it's great, a greater control over your money and adding to your legacy. So a little bit about, sheltering your assets. Again, it allows you to overfund a life insurance policy and, pull that money back out tax free. Loans are not taxed. The death benefits of a life insurance policy are not taxed. It's just a way to really safeguard your money. And sometimes whether you're a nurse, I was talking to a nurse and she was saying that, like, she's overfunding her 401k because it reduces her taxable income. Well, that's one strategy, but taxes are going to be going up. You're putting your money in a tax deferred vehicle where the government is going to say, okay, great, you've been putting into this 20, 30 years. Now you're ready to use it. Now here's our cut. Where's our cut? So
Mhm.
it's better to pay the taxes now, put the money away in a tax-free vehicle so you let it generate wealth and accumulate. And then when it's time to take it out, it's tax-free. So I hear a lot of people, asking that question, but when you really do the math, it's a no-brainer. Like, you would rather pay taxes now versus later.
And none of this has changed with the big, beautiful bill that was just passed. There's
Yeah,
no
this
implication.
is private. Whatever they're doing, this doesn't, you know, impact that. Again, I haven't read how many pages or hundreds of pages it is, but I know for sure that this is not going to be impacted by that.
I just asked ChatGPT to give me a summary of it and see what it says. So I didn't read all those pages either.
Yeah, it's a lot in there, and that's how they get people. They put so much stuff in there, and like people, unfortunately think it's a great idea, but you got to think about who's in control. Like the wealthy people, they want to protect their assets, not the common folk. But
Right. And it's
yeah,
the wealthy people, not all wealthy, but most wealthy people do have life insurance policies so that
right.
they can continue on. And it's the poor people who don't have life insurance policies because that's one of the reasons why I got out of the business back then is my clientele was losing jobs and they didn't see the benefit of having an insurance policy. And soon as times got hard, they quit paying. And it's like, you know what, let me go back to my medical records.
Yeah, and you know what? That's part of what drove me that I know most people don't know about this. Where I come from, they're not going to be all excited about putting money into a life insurance policy. But with this debt-free life program, um, imagine being able to knock out your debt in a matter of years versus 9 years or less versus 30, 40 plus years. Now that you have no debt, where is that money going to go work for you? You want it in your policy. And so we with this policy, the first few years you're learning how to get out of debt and now you're able to grow your money and you're not so much concerned about, hey, if I just want to pay the light bill or this policy. This really sets you up and your family for financial freedom in a sense.
Okay.
Yeah, and what this slide is simply talking about, again, like we were just talking about this, um, the IRS can't doesn't have access to this policy. When you take a loan from it and you're trying to buy a house, that's not something that's going to go against you. Like these loans and this policy isn't something that's is accessible and goes against you as far as your financial record. So. And it talks about the 529 plan. Like for those who don't know, like when you're 529 plan, when you're trying to save for your children's college or whatnot, they have to go to college to use that money, or there's going to be some sort of penalty or whatnot. You get to use the funds in whatever way you want. You have a kid who's now 18, 19, 20, and they decide to go to a trade school versus traditional college, that's okay. They want to be an entrepreneur, that's okay. You get to use the money in whatever way you want rather than being regulated and controlled by some other entity saying, hey, that's not the way it's supposed to go.
I like that.
Oh, did it again. Something's going on with my.
You're not sharing screen again. I just see you.
Yeah, my bringing it back up now.
Technology, don't you love it?
Yeah, shut down on me. So let me see. Here we go.
Just to tell you the age I am, back in the 80s, computers were just becoming like personal computers in your house. So yeah, we did things a whole lot different back then. It didn't have all this vast knowledge.
Yeah. Are you able to see the screen now?
Yes.
Okay. So how the banks make money. So again, when you get up to let's just say 1,000 in savings, and you're earning 1% in simple interest, and again that's generous, you earn $10. And so what does the bank turn around and do? Okay, other people need, money. So I'm gonna, let someone borrow money for a mortgage. They earn 3%, auto loan, business loan, so on and so on and so on. The bank is now making money off of the money that you put in their bank.
Yep.
That's like most people don't really understand it. It's called, I think, fractional fractional banking. It's read up on it. It is a mind blowing concept that makes the bank so wealthy. And what we're essentially saying is you have that ability to not, you can't do that because the insurance company doesn't just make money out of thin air like the federal government does and banks do. But you have the ability to make money by warehousing your money in your own banking system. And so I wanted to share this scenario of buying a car, something that a lot of people can relate to, right? So when you go get a car loan, and option A is you take a loan out for 30,000 and for a car, and you pay 3,900 in interest to the bank or another financing company. And what happens is over time, you no longer have access to that 30,000. It's working for someone else now. You paid over $3,900 in interest, but you own the car. Cool. Car's paid off. Hopefully it runs like my Honda is going strong, 8 years, not many problems, right? It's gonna last you 200, 300,000 miles. Option B, right? You pay it with cash. All right. Over time, what happens? 30,000 is gone. It's no longer working for you. That's not the best thing. I was actually at a networking event a couple of months ago, and he said a guy bought two vans for his company worth 50,000. He bought it cash. Just I was like, ugh, money just gone, no longer working for you. But the great thing is, no pay, no interest. Okay, kind of broke even there, and you own the car. So what we help people do, you take a loan from your policy, right? Now you owe over $3,900 in interest to yourself, right? And the company, the insurance company. And over that time, as however you structured it, you were able to earn 9,000 plus dollars in compounded growth because you kept your money in your system. So over time, you still have the 30K working for you. It didn't leave anywhere. You netted your net profit. Again, you're splitting that earned interest from the insurance company with dividends and so on. You were able to earn over $5,800 in interest, and you own the car. Win,
Winning.
win, 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 win. Exactly. And so again, it's you're simply, as I like to say, like you're taking your money out of your one pocket and putting it in another so that they can grow in a different way compared to what you're used to.
So would you have advised that business owner to take that 50,000, put it in a policy
Mhm.
and
Exactly. So whether you're a business owner that has a lump sum, let's just say you decide you want to put, I don't know, 300 a month, 500 a month, 1,000. Some people put 5,000 a month, depending on the higher income earners, right? And you have a lump sum, you can dump all of that lump sum of 50K in there, and then 14 days later, 15 days later, you can borrow up to 90% of the cash value, right?
uh-oh, did you freeze? Make sure I still got connection. I do. Dashaun froze on me. Let me call him.
I'm about to jump back on right now. Did yours
I
did
was
yours
gonna
end or
say, you know you froze.
let me jump back on
Okay.
and okay.
You were talking and it just froze, so you're gonna make me edit this video,
I don't
huh?
know what's going on.
Yeah, I don't need that. I was to check, make sure my internet was still going, and it is. So, yep, I'm still on.
Mm, I don't know what's going on with my internet. It's saying I got a connection. Let me I'm switching for some reason it turned on to my hotspot. Just my internet went out.
Okay, I'll get off the phone and wait for you.
Okay.
Okay. This is where I wish I was, somewhere really looking at, well, I am. I am looking at this on my computer. So manifestation is real. Palm trees, beautiful. I can feel the breeze. Mm.
About to switch over to my computer now. One second.
Okay.
Technology.
I wish we had it when I was in my 20s, though. Shoot,
Yeah.
man,
First world problems, right?
man. Oh well, wasn't meant to be.
Yeah. All right. So where did I leave off?
We were talking about dumping lump sum into
Yeah.
the policy.
Right. So with that business owner or a homeowners who got to put down a down payment, they have to give it away. Why not just put it in a policy for safekeeping, and that's going to keep growing for you right before, even like well before you do that, more preferably. But you can do this, and it's not going to change your debt to income ratio. It's something that is not going to show up. It's you want to put your money in a warehouse of wealth, and it's going to continue working for you.
So can this policy be used as an asset?
Um, Technically, it's an asset that's growing for you, but I hesitate with that because most assets, the IRS are looking for assets and like, the capital gains and all that stuff. This doesn't register. And so it's technically not an investment, but it does grow for you. It's risk free. It's going to be tax free, but it's not an investment.
Okay, so I'm putting my lender hat on right now, trying to see if qualifying someone that has one of these policies, if that would need to be reported and used to say they qualify for a loan.
I see. So the thing is, like, so over time, these policies does generate over time a large, what we call it, dividend. First, I'm just using random numbers. It could be 300 the first year, 800, it gets to 2,000, 5,000, depending on how people fund these. It does generate income, and there's multiple strategies that we educate people on. You can use that to pay the policy or buy more death benefit coverage, or take it out and use it to pay down your tax bill, your property taxes. So many things you can do with it, but I'm not sure about that one. That is a good question.
That's something I wrote down. I'm going to look into that.
Yeah.
I'll let you know what I find out.
Okay. Thanks. And I'll do my homework too, and we can have a conversation about it.
Okay.
So again, this slide is just talking about BOLI, bank-owned life insurance. This is a top 25 list of the amount of banks, the amount of banks of the amount of life insurance policies they have. They have these same types of policies out, and they're making money. The banks are putting their money with life insurance. So why not just do what the wealthy do, right? So here, this is the part where I'm talking about the debt-free elimination. And I do want to take a moment to say, okay, what about the people who don't have debt? You're in what we can call phase two, because we're trying to get to everyone to make sure they don't have debt. You can create this policy for yourself, even if you don't have debt. now you have more of your money working for you. So that's what we're trying to get most people. Like a lot of people out here having debt, and so we start with the debt-free life program. But the point is to get to the point where you don't have debt. So I don't want people watching this thinking, "Well, I don't have debt. I can't get this policy." No, you can use infinite banking to warehouse your money, and make it grow for you. And so this is part of the process of what we do for people. We call it like reallocating inefficient debt. If you take a look at like the credit card, the medical, furniture, mortgage, all these things, there's usually a balance, a minimum payment, and interest rates and all that stuff. We look at all of that stuff. But if you see on the minimum payment here, this with the credit card, they're overpaying it. The dental, medical, they're overpaying it. The furniture, they're overpaying it. And sometimes people overpay their mortgage to try to get that 30-year mortgage down to 15, 10. That's what we call inefficient dollars. We're going to tell you, why don't you put that money in a policy and make it grow for you? And then we're going to show you, we're going to run your numbers. We're going to give you a side-by-side comparison of strategy you're doing now versus using this policy and how fast we can take out your debt. So that's what we're looking for. And so here's a quick case study. Renee and Anthony, they had their goals. They had the IRA. They wanted to save for retirement. Um, Wanted to eliminate debt, and they filled out the worksheet. And essentially, we were able to take a look at all of the assets that they have, all of the debt that they have, and essentially come up with a plan for them. And again, they weren't holding anything back. They showed us, okay, this is our interest rate, this is the balance, this is the payment that I'm usually paying. For example, on the Visa, if they're only paying 55 and that's the minimum, we need to know that. If you're telling us, yeah, I usually overpay, we want to know how much are you usually overpaying. We want to get as detailed as possible. And once we do that, we have an idea of how much money is coming in and how much is going out to your debt, and we could devise a plan that's actually going to work for you. And so here we want to kind of take a time to chat about what's the real cost of interest. A lot of people like to say I got a 2% interest rate, I got a 3% or 5% interest rate. But when they look at that amortization schedule, they notice in year one that most of it is going towards the interest. Year 10 and so on and so on. So this is what we need to educate people on it. 78% in year one is going towards the interest. Year 10, 65%. And I don't know the exact rates, but they're saying like most people between year one and year 10 are refinancing or buying a new house, and it starts over again. So most of your money is going away from you and going to the banks. So there's so many strategies that we can use to kind of help people get to the point where they're paying off your mortgage in 9 years or less without spending anything more. But to continue here, year 20, you're paying 42%. And it isn't until the last year where you actually get that 5% interest rate. And so it's really just thinking about, okay, where do I want my money going? Most of paying interest, or really putting it in a place that's going to work for me. And so here's what Renee and Anthony did. They had, again, we got a snapshot of the situation. They had over $36,000 in retirement savings, contributing 300 a month, 5% interest rate, and they were in a 25% cash bracket. And so what that means for them, when retirement comes, they were going to have over $408,000 in before taxes. But if you see that after tax, over $100,000 is gone,
Mm.
because they wanted to continue with or they would have continued with the traditional retirement plan. But here's what we were able to do for them. So they got out of debt in 7.8 years, saved over $122,000 in interest. And I think about that number, you know, sometimes homeowners are going to pay just because of the interest almost double what the actual house costs. What would you do with that money? Well, how would your life look like if that money that you were paying in interest was actually working for you? Um, and they were able to increase their savings by retirement savings by over $2,000 a month, which allowed them in 30 years going to have over $1 million in retirement funds.
Mm.
So again, the current plan was retirement savings of over 306,000. Yeah, 306,000, and with the debt-free life program, over $1 million in tax-free retirement savings, and they would have saved over 122,000. So when people see this first step, it's like it's a three-step process. Um, we will want your clients, anyone watching this, if you basically completed the first step now, watching this video, understanding how it works, and the next steps would be, get your most recent statements and, like sort them out. Let us we'll give you a form to fill out or a link to fill out, and so you can understand what your financials consist of. All your assets. Sometimes people have outstanding or 401ks at previous jobs that they never did anything with. That can be actually funneled into your policy, just so people are aware. And again, we want the interest rate, the minimum payment. Are you overpaying? We're going to look at all of that stuff, and we're going to need some information about your income. The
What
next
about IRAs?
IRAs as well. Like that can be transferred into this policy. I will say if it is a current 401k and at your current job, very limited on what we can do with that because it's still actively with your current employer. But previous employers, we there's a little bit more flexibility on what we can do.
Okay, good.
So you'll want to do a Zoom meeting because we're going to show you what your numbers are. Just like how we just show you what Renee their plan what there was initially versus with the Debt Free Life program. We want you to be somewhere sitting uninterrupted, not on your way home from driving, anything like that. We want you to pay attention and see what these numbers can really do for you. And again, just being on time with no distractions and whatnot. And so, um, and again, I just wanted to remind people of what they're transitioning from. So before IBC, most people are going to be in the debtor or saver and letting their money go from them, um, making money for someone else essentially. Well, after you get your infinite banking policy, your debt free life program, you're now on this trajectory of have your money continuously work for you no matter what life events come your way and you need access to your money. You're going to be able to have access to it, and it's just going to continuously grow and grow and grow and grow. And that's why I got into this is the program that I want to tell everyone about.
So I like to go with, or like to know if somebody has had a positive experience with having this. Do you have some kind of testimonials? I know you're new in the business and probably don't have any personal, but some from your company, maybe?
Yeah, so I would say these are real clients. Again, my mentors, Renee Anthony, my mentor, that was his client. The clients of um, the one that I showed you, Jamie, she's a nurse. Real clients. I do have. Let me see if I can find a brief um, 1 minute testimonial video. Um, yeah, and it's just like a 1 minute video. I'll see if I can find that here. But yeah, it's I'm going to work on that. Actually, I'm going to be reaching out to people so I can do a series of profiles, and I'm going to. My plan is to find nurses, teachers, like all type of professions, so I can help them get this policy started and let others know like this can work for almost anybody. If you're trying to pay off debt, if you have some savings, let your money start working for you.
Because I have an annuity that's gonna mature in December.
Okay.
So I could take that and put that into this infinite banking.
Yeah, I would say. I know my mentors, they're really heavy into annuities, and that part I haven't learned more about. Like, that's a really good question. Is it more uh, efficient for you to put that into one of these policies or allow yourself to just live life off of your annuity because the way they're structured, you're not supposed to be able to outlive your annuity.
Oh, really?
Yeah. Well, if I know my mentors, they do annuities. Um, we can definitely set up an appointment where we could just take a look at it and just see what can be done. It's
Okay.
either keeping what you have, no need, or see if we need to make some changes.
Okay. Because I do want the beneficiary to be the Charlene Crossley International School,
Okay.
um, because I want them to continue on even after we're gone. Now, I think she's too old to actually have a policy. I don't know if there's if you know, the cutoff limit for having
How
an
old is she?
86.
Yeah, 86 I think is the limit, but here's the great flexibility about it. So sometimes people are not going to qualify for because you got to qualify for life insurance. You just don't buy it.
Right.
Um, but the great thing about it is you can say if she has funds and she needs to put funds somewhere, or another person who doesn't qualify for health insurance, or a person who's 90 but has some income coming in. Maybe they have a grandchild. Maybe they have a son or daughter. They can get the policy on the younger, healthier person that they have what they call an insurable interest in, right? And now they're the owner of that policy and they're able to have their money work for them. And so when let's say the older person in this scenario dies, the policy automatically goes to the person who's the life insured. And so, but before that time comes where the person passed, the person is able to have a policy that they're able to use and grow their money and finance their day-to-day living. And then, am I still there?
You still here?
Okay, I just want to share. So I think you froze. But they're able to take advantage of the benefits of having this policy. And then when they finally pass, they're gifting this policy to that son or daughter or grandchild,
Okay.
giving them a
Okay.
head start.
Okay. Okay. Well, we'll talk about that. Well, this is very good. I appreciate it. I got a better understanding, and yeah, we didn't have anything like this back in the 80s with the company that I was with. So I'm
Yeah.
glad to see the full. And I always tell my clients too to pay off their mortgage, like pay more toward their interest, um, toward their principal on their mortgage so that they don't have a 30-year mortgage and they decrease it down. But you also do it with you look like credit cards and other things like that. So that's
Yeah.
something a little bit
This will
different.
be a much more efficient way. Again, like we're talking 9 years, not just your mortgage, your car note, other debt, because it gets to the point where it's really going to work for you. And, there's certain strategies that, I'm aware of. Like, so say we knock out all your other debt, or if you, like, I'm not sure if you talk to your clients about like HELOCs and stuff. Sometimes it's beneficial to get a HELOC. Say you're at the halfway point of paying off your house, get a HELOC, put all that money towards the rest of the balance, and now let's say just a random number. Okay, your mortgage was $1,500. Now let's say your HELOC interest only payment is $1,500. Every time you make a payment, that payment comes down that you owe. Unlike the fixed monthly mortgage, which is going to be at 1,500. And so after 6 months, now you're only over $1,200 a month. And what do you do with that $300 difference? You put it back into your policy.
Mm.
You're freeing up cash flow. And so that's one example. Again, there's so many things you can do with this policy, and it just helps people reach their financial freedom a lot more sooner. And I do have that video up that I can share, but let me know when you're ready for that.
Well, what I was going to say was, yeah, you said a HELOC, and for those who don't know what that is, that's a home equity line of credit.
Mhm.
So you have to have some equity in your house that you can take out. And so, yeah, we're going to set something up where we can talk about how that can help. because I
Yeah,
do like that strategy. There's a lot of people now who are going to need to tap into their home equity and don't know actually, the best way to do it. So let's
right.
talk about that on another session.
Yeah, for sure.
But go
So,
ahead with your video.
okay. Let me know when you can see.
Yep, there it is.
Okay. All right. So again, these are real clients, not my clients, but these are real clients of our program who's went through it.
With interest and everything else, we're in debt for over 400,000.
$213,931. $555,000 of debt will take me 30 plus years to pay. $161,398.
Okay, we are so excited.
I know the month and the year that we're going to be out of that.
You originally were gonna have your debt paid off in 27 years. How many years are we gonna have it paid off now?
6.2. I feel like a weight has been lifted off my back.
In 6.5 years, I'll be debt free.
9.2.
I'm so ecstatic.
We have a retirement of over $1.2 million now.
Feels amazing to know that I can pay that off and have that much retirement savings. Pretty darn good.
If you want to be debt free, take a chance and just do it.
Yeah. I love it.
Nice. All right, Dashaun. Well, thank you very much for your time. And how do we get in touch with you?
Yeah, you can reach me at my email, Dashaun Dunn, sfg@gmail.com. And that is DASHAUNDUNN, as in Sam, F as in Frank, G as in good at gmail.com. Or you can reach me on my cell number, 310-863-8933. You can find me on Facebook as well, Dashaun Dunn. Websites and Instagrams, TikToks is coming very soon. And yeah, you'll be able to find me, and I'll be doing a lot of teachings and education on these platforms just to kind of spread the word about this because a lot of people need to know.
That's true. That's true. Well, thank you very much. And you have a great day, and we'll be in touch.
All right. Well, thanks for having me.
All right.